The live intraday price for Lithium Americas Corp, trading under the ticker symbol LAC on the New York Stock Exchange, is currently sitting at $5.16 per share, representing a solid gain of 2.58% in today's active trading session. While most market spectators are staring at that minor green tick, trying to guess whether the daily upward grind will sustain itself until the closing bell, the real action is happening beneath the surface, far removed from the simple price quotes you find on basic investing sites. Big institutional players are aggressively adjusting their exposure, and what looks like a quiet consolidation pattern is actually a high-stakes standoff between debt restructuring pressures and the massive capital requirements of the domestic supply chain. The standard expectation when you look at a junior mining company like Lithium Americas Corp is pretty straightforward. Most self-investing individuals see a stock sitting around $5, remember that it once flirted with the double-digit mark at $10.52 over the last 52 weeks, and assume it is just waiting for the next big wave of electric vehicle demand to surge back upward. The common consensus across online investing communities is that if you hold this asset long enough, the sheer strategic value of its Northern Nevada asset will guarantee a massive payday. But the reality of raw commodity development is far more brutal and complex than the clean, optimistic charts displayed on popular retail interfaces like the Robinhood app or the SoFi Invest platform. The underlying reality is that building a multi-billion-dollar extraction facility is less about the mineral itself and more about surviving a punishing corporate cash burn before a single pound of commercial material is ever sold. If you analyze the recent daily swings, Lithium Americas Corp has been exhibiting some fascinating volatility that exposes exactly how institutional capital views this asset. Over the last month, trading volumes have regularly spiked well above the 10 million share average, signaling heavy accumulation and distribution matching at these lower levels. When the company reported its first quarter financial results just a few weeks ago, the net loss narrowed significantly to just under $500,000 compared to a staggering $10.7 million in the same period last year. For a retail investor monitoring their individual brokerage account on a phone screen, a narrowing net loss looks like a green light to buy. However, the sophisticated desks executing block trades through an interactive brokers platform read deeper into the balance sheet. They notice that while the net loss looks under control on paper, the capital expenditure commitments are accelerating at a pace that creates a very specific type of equity dilution risk. The announcement of a $250 million equity distribution agreement designed to enhance financial flexibility tells you everything you need to know about the current situation. The company needs cash, and it needs it continuously to keep construction moving forward. This dynamic creates a constant tug-of-war on mainstream trading venues, whether you are placing orders through a standard Fidelity brokerage setup or tracking momentum on a fast-paced platform like Robinhood stock trading. When retail sentiment gets overly excited about domestic manufacturing and supply independence, the stock pushes up toward the $5.50 range. But as soon as that momentum peaks, institutional algorithms use the high volume to distribute shares, knowing that the equity distribution agreement means a steady stream of new supply could hit the market. It is a classic example of how short-term daily swings can completely mislead someone who is self-investing without understanding institutional order flow. The massive trading volume we are seeing right now is not necessarily a sign of a retail-driven breakout. It is the friction of a company slowly funding its infrastructure through the open market. Comment below how many shares of Lithium Americas Corp you currently hold in your portfolio right now, and let me know if you are actively buying more at these levels. To truly understand why the stock is behaving this way, we have to look at the broader sector momentum and the macroeconomic pressures weighing down the entire battery materials complex. Over the past year, the price of battery-grade lithium carbonate has experienced a severe cyclical downturn, dropping from historic highs down to levels that make traditional extraction methods marginally profitable at best. This macro pressure has dragged down established producers and junior miners alike, causing a sector-wide compression in valuations. When you pull up a comparison on advanced analytics tools or check your asset allocations across Fidelity mutual funds and diversified Fidelity ETFs, you see that the entire materials sector has been fighting an uphill battle against high interest rates. High interest rates are poison for junior mining operations because they drastically increase the cost of servicing debt and raise the hurdle rate for major capital commitments. Now, let us contrast that harsh reality with what Lithium Americas Corp actually does and how its corporate structure came to be. The company focuses exclusively on developing, building, and operating lithium deposits and chemical processing facilities in North America. Its crowning achievement, its ultimate asset, is the Thacker Pass project situated in the McDermott Caldera in Humboldt County, Northern Nevada. This is not just an ordinary mining claim. It represents one of the largest known lithium resources in the United States.
The business model relies entirely on bringing this single massive asset into commercial production to serve as a foundational supplier for domestic manufacturing. If you look back at older reports and past performance, the company actually split from its Argentinian assets in a major corporate separation designed to unlock pure play value for North American investors. That structural shift was cheered by market analysts at the time, but it also stripped the entity of near-term cash flow from active South American operations, leaving it completely reliant on capital markets and strategic partnerships to fund Nevada. This brings us directly to the massive catalyst that occurred late last year, which still dictates the stock's valuation floor today. The company secured a conditional commitment for a substantial loan from the United States Department of Energy. This loan was hailed by online investing networks as a massive victory that would completely de-risk construction. It provided a powerful psychological safety net, causing many retail traders to log on to their SoFi trading platform or use the Fidelity mobile app to buy shares, believing the funding puzzle was permanently solved. But here is the catch that separates expectation from reality. A conditional loan commitment is not a blank check deposited into a corporate account. It requires strict milestones, environmental compliance, matching capital contributions, and rigorous institutional oversight. The market has slowly realized that while the government backing provides structural stability, it does not prevent the company from needing to raise hundreds of millions of dollars in dilutive equity to meet its end of the bargain. When you evaluate this company against other long-term structural options, like setting up automated allocations in a Schwab Intelligent Portfolios account or picking stable dividend payers for your Fidelity IRAs, you begin to see why LAC sits in a highly speculative category. It is an all-or-nothing bet on project execution. The company boasts an impressive current ratio of 7.36 and a quick ratio of 4.62, showing that its near-term liquidity is robust enough to handle current liabilities. However, because it has zero commercial revenue today, traditional metrics like the price-to-earnings ratio are completely negative, sitting around minus 8.8. It trades at a price-to-book value of roughly 1.3, which seems remarkably cheap compared to the broader metals and mining group. For an investor utilizing an intelligent portfolio strategy or seeking institutional investment help, that low price-to-book value looks like an incredible margin of safety. But that asset value is tied up in clay-hosted lithium processing technology that has never been deployed at this specific commercial scale before. Looking forward into the future outlook, several distinct scenarios could unfold for Lithium Americas Corp, and each one will be defined by how reality matches up against the market's current expectations. The absolute best-case scenario is that the company hits every single construction milestone at Thacker Pass over the next 24 months without experiencing major cost overruns. If engineering timelines hold and the broader commodity market starts to recover as global supply gluts clear, the stock could easily re-rate significantly higher. Under this scenario, the current $5 price point will look like an absolute steal for anyone who managed their positions through a Robinhood cash management account or an individual brokerage setup. A successful production ramp would transform the company from a speculative developer into a critical piece of national infrastructure, attracting massive inflows from institutional funds that are currently restricted from buying pre-revenue companies. Conversely, the risk side of the equation cannot be ignored. Junior mining history is littered with projects that looked perfect on paper, but suffered devastating delays during the transition from pilot plant to full-scale commercial operations. If Lithium Americas Corp encounters processing bottlenecks, or if metallurgical recoveries from the unique Nevada clay beds fall short of expectations, the cash burn will intensify. If that happens while lithium prices remain depressed, the company may be forced to tap its equity distribution agreement even more aggressively, diluting existing shareholders to a fraction of their current ownership. Furthermore, any shift in domestic political support or changes to federal manufacturing credits could alter the economic viability of the entire operation, hitting the stock price hard and catching casual investors on general investing sites completely off guard. When you synthesize the entire situation, the stark contrast between what the general public expects and what the operational reality demands becomes crystal clear. The general market narrative treats Lithium Americas Corp as a simple high-beta play on clean vehicle adoption that is currently on sale. The deeper structural reality is that this stock is a highly complex project finance puzzle, where management must perfectly balance dilution, government compliance, and massive engineering challenges in a depressed commodity environment. The stock is currently sitting at $5.16 because the market is waiting for concrete proof that dirt is being moved and facilities are being built efficiently. It is not an asset you buy for quick, predictable returns. It is a long-term position that requires immense patience and an understanding of corporate finance. Whether you manage your capital independently using a sophisticated interactive broker's account, automate your strategy through an intelligent portfolio, or place casual long-term bets via standard Robinhood fractional shares, you must recognize that the volatility we are seeing today is the price of admission for an asset that is trying to build the future of domestic supply from scratch. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.